John, thank you for joining us today. The headline for your note was "Easy to like software, probably too easy." Explain your overall outlook.
Yes, thanks, Julia. Listen, it is easy to like software. It's a great sector. It's got a great business model with recurring revenue. In difficult times, that recurring revenue holds up, but new sales are not sold. There's not a lot of new sales in difficult times. And we think we're in a difficult time, and it could be a prolonged, difficult macro backdrop. That's what we're talking about. We're talking about some of these companies. Listen, people know that software is a great place to be. That's why a lot of these companies trade at the valuations they do. And perhaps it's not going to look so great over the next year or so.
But let's talk about those stocks you do have a buy on: CrowdStrike, Oracle, Splunk. What distinguishes those? Why are you so bullish on those when you're so negative on some of the others? Is it just about valuation, or are there other underlying trends?
Every company is a little different. So yes, valuation comes into play every single time. But one of the things you mentioned early when you in the introduction, you talked about security. Well, security's held up much better than other areas of software. And we do a lot of work trying to understand what the new business sold in a quarter was. It's not something that is just obvious. You have to apply some accounting and some math to it, and you can calculate that with some relative a high degree of accuracy, we think. And security did really well in the first quarter relative to the rest of software. The rest of software saw a market drop off. And if you look at the average non-security name in our coverage universe, growth in the first quarter was about 6% for new, what we call annual contract value, so new business, versus 42% last year. Versus security was about 39% in the first quarter versus 49% last year. That excludes Okta, which had an issue in the first quarter where they had a security incident, some call a breach. But so John, that's what separates security anyway.
Yeah, when I look at your initiations and I look at your sell calls on Snowflake, Okta, CRM, Workday, how much of this has to do with just the sheer number of software companies we have seen come to public markets over the last few years, and in public markets still? There's been so much money. Do you think that too much has been made that is unnecessary, and now you've got an economic downturn bundling from some of the bigger players like Microsoft?
Microsoft is a threat for some of these players, certainly, Deidre. But I don't think there's too many software companies out there. Software has been on a sort of a secular updraft for a while, and we think it's still got legs to go. Some of these names, though, the calls on Salesforce and Workday, we believe that a software company at sort of its mature stage should have free cash flow margins of around 35%. We don't think that Workday can get there. That's one of the issues with Workday. It's a great company. Like, listen, all these companies are great companies.
Yeah.
If you're a public software company, you're a great company. But Workday has this proprietary infrastructure that it's built on, and we think that's a big part of their R&D spend, or maybe not half of it, but a big part of it. So they'll never hit that 35% free cash flow margin. Similar on Salesforce.com, if you look at the free cash flow margin and you take into account acquisitions, it's been negative on average over the last 6 years. Even if you exclude Slack, which last year it's still been like 3%. So that's every one of these cells are not like they're not bad companies, but there's reasons that they're probably not worth what they're trading at.